We definitely see some pockets of froth. Some areas of the market are detached from fundamentals, no question. But overall, from a broader standpoint, we do not see a bubble. In fact, I think what's really not discussed enough is the valuations for the S&P 500. They're elevated, but they peaked back in June of last year. They've been moving sideways since then. The 25% gain we've seen since June have been earnings driven. And we continue to think that the earnings side of this market remains underappreciated. On the other side of this pandemic, companies are coming out leaner, meaner than ever. And we actually saw a 2020 end with cash flow margins at a record level, which is just amazing.
So, Keith, why is it that on my social media, my Twitter feeds and everything else, I see so many people talking about the fact that markets are overly inflated, there's bubbles everywhere, that this is froth, this will all end badly? What is it that they are seeing? Why do people say that valuations are so elevated if you're putting things in historical perspective and saying maybe they're not?
Well, I think by any historical measure, valuations are elevated. I would say for the broader market, the S&P 500 specifically, I think you can justify somewhat higher valuations based on lower interest rates, but also the change in sector composition is a lot more towards tech and growth relative to history as well. You have much easier access to the market than ever, cheaper access as well. And on a forward basis, as we look forward, the reason why valuations still look even more elevated than we think they are is because earnings continue to move forward, and we think earnings will continue to snap back stronger than the consensus. And we're already seeing this. This earnings season is epic, really. When we came, at the end of last year in December, for the fourth quarter, analysts were expecting a negative 12% earnings quarter. Currently, we're actually now positive. So think about that. The fourth quarter that we just ended will now be above earnings from the year before, which was the last period before the pandemic.
How much of that, Keith, is really revenue growth as opposed to effective cost management? Because some say that there is a difference, and a notable one, between driving earnings growth because the business is getting better as opposed to driving earnings growth because you're slashing jobs or you're cutting costs everywhere.
Well, it's both. And what's interesting in this earnings reporting season, the revenue beat rate is about 78%, which is on track for a record. So it's companies becoming leaner and meaner, but also the sales side. And if you think about it, there's a high correlation between economic growth and sales revenue. We think economic growth in the U.S. this year will be the strongest since 1984. So think about that. More sales coming through with those better GDP numbers flowing to the bottom line. But I also want to just take a step back. We're positive on the market, but we certainly think we're moving to the next phase of the bull market after that initial snapback, which means much more moderate gains, some choppy waters similar to what we saw in 2004 coming out of that bottom and 2010 as well. But we think it's going to be another solid year for the equity market, and we're already on a good pace for that.
What types of companies, sectors, industries are the ones that actually do better in that next leg of the bull market, the choppy type one that you may be referring to after we saw the bounce off the lows? Is it still big cap tech? Is it energy? That's been the theme for the last few months now.
Yeah, listen, big cap tech, I think, is held in there really well. I think on the margin where we see more value is something like the financials. Financials are still trading at about a 40% discount to the overall market. We're seeing earning trends move up. We're seeing the yield curve at the steepest level in over a year. So I think financials is a good spot, specifically the regionals. And we also still like some of the global industrials and also the materials, which should benefit from a continuation of the global GDP recovery. What's also notable in the U.S., we continue to see GDP estimates revise higher, which is unlike what we're seeing in other parts of the globe, like Europe, for example.
Now, Keith, have you had to change your investing strategy type methodology, tracking methodology for things like cannabis stocks, for things like cryptocurrencies?
Yeah, listen, I think those are some of the areas that are more speculative. We're really focused on the areas where we can really dial in on where the fundamentals are, where the earning strength is, and so forth. So that's really where we're more focused with our investment strategy still.
And then before we let you go, what's the thing that scares you the most about what's happening with the market right now?
Well, no, I think at some point this year, it could be where we have all this fiscal stimulus and more fiscal stimulus coming through after we've had so much fiscal stimulus that things can overheat. I don't think that's a this month concern, but I do suspect later in the year, as those economic numbers start to really accelerate, the market will start to think about, okay, when is the Fed going to start pulling back? And that will inject some volatility into the market. Again, not a today story, but something to think about as we move later into the year.
Shepard Smith here. Thanks for watching CNBC on YouTube.